Welcome back. Now, at the half-year mark, Pan-African Resources has reported a near 44% slump in headline earnings per share. This as the miner produced and sold less gold during the period, while net debt skyrocketed to almost $229 million. Company CEO Cobus Loots joins us with his assessment of the performance. Cobus, thanks so much for your time today. So, high gold prices not necessarily filtering through to the company's performance. As we get started, just walk us through some of the factors that weighed on earnings.
Yeah, so I'd say the biggest two single factors that weighed on earnings. Number one, we had to have a synthetic forward, effectively a hedge, which we had to take out to fund fund a portion of the construction of our MTR operation. And then the underground production, certainly from our Evander mine, was not up to scratch. So we've taken corrective measures and we're definitely seeing an improvement there. But, I think positively, we commissioned MTR, which is a world-class project, ahead of schedule, below budget. That's going to be producing cash flows for more than 20 years, producing at an all-in sustaining cost of $1,000 when the gold price obviously is way higher. And the rest of our tailings portfolio really produced. And then excitingly, you mentioned the net debt. The debt is not a good thing if it's not done for the right reasons. But the debt you see on our balance sheet really is for long-term growth, principally MTR, and then also our Australian business, which will be producing before the end of June. So I really think it's an exciting time for Pan-African in this gold price environment. The next 6 months, you're going to see the impact of the gold price come through very nicely. So we unhedged materially. All of the sort of profits now will benefit because of the higher gold price.
Talk to me more about that Australian operation, which you say is not delivering any production at this point, but you see that starting to come through from June, right?
Yeah, we only acquired this asset in December, but we'd been looking at it for about a year. It was in private hands. It is the highest grading gold field in the history of Australia, and we're building a processing plant which is 3 times larger than anything that's ever operated in that field. That gives us really nice economies of scale. So I was on site about a month ago, and the guys are doing fantastic work. We'll be commissioning in the next couple of months, and then we'll start operations in April and May. And we're forecasting a production already in this financial year of between 7,000 to 10,000 ounces. And then that ramps up very nicely for the next financial year, 48 to 60,000 ounces, again at a very competitive cost of about $1,250 per ounce. The global average cost of production at this point is sitting above $1,500.
So there is optimism rather on the Australian side, but I want to look at perhaps the Sudan side, right? So I know the group suspended exploration activities in that area, of course, this on the back of civil unrest in the country. What's the progress on that end? And just take us through the losses you had to account for that temporary closure.
Yeah, so it's quite sad. It's incredibly sad what's happening in the Sudan, and the world, for some reason, is ignoring this conflict. You said it was unrest, but it's a civil war with hundreds of thousands of people dead. So that's a terrible situation, and it's very sad for us, both obviously from a personal and social perspective. It's also a tragedy from a business perspective because the country is so well endowed from a minerals perspective. So true Pan-African fashion, we don't have massive exposure. The total impairment that we've accounted for is about $3 million. But we can't see ourselves spending capital in an environment where we can't guarantee returns to our shareholders. And that's really, I think, part of Pan-African's track record is if you look at our success in terms of capital investments and paybacks and returns, we're sector leading, and we can't be operating in a jurisdiction such as Sudan. And we really hope and pray that things improve and that we can go back into the country in due course. But we don't need the likes of the Sudan to have very attractive production growth in the year ahead. We're guiding to close to 300,000 ounces for FY26, which is exceptional. None of the major gold producers can increase production by, say, 30 to 50% like we will do in the next months.
All right, let's look at your expenses, the costs in particular. All-in sustaining costs ticked higher during the period. This time last year, the group had managed to lower costs, right? What's been the contributing factor to the higher all-in sustaining costs this period?
Well, the biggest contributor has been the lower production at the Evander mine. But if you now look at our cost guidance for the full year, so for the full year FY24, we produced at just over $1,350 per ounce. I mean, we're guiding now $1,450 to $1,500. That's only a 10% odd increase. And one has to take account of a stronger exchange rate. For the last year, the exchange rate was 18.70 to the dollar. We forecast costing 18.50, plus then big inflationary pressures, electricity, reagents, which are largely outside of our control. But again, the beauty of our portfolio, South African miners are generally known for being high cost globally. Yeah. It's not the case with Pan African. The global sort of cost of extracting gold's gone up to above $1,500. So we compare very well with the global sector.
All right, I want to talk to you about your debt levels. You did touch on it at the top, but how comfortable are you with where debt is at the moment? I know you've mentioned that you expect to be de-geared in the next 12 to 18 months and are also looking at reinstating interim dividends.
Yeah, so we're never comfortable with debt. It's much nicer to work for shareholders than to work for the banks, even though we like our banks. And the money that they've lent us over the years has meant that shareholders have not had to contribute for the very attractive growth in the Pan African's portfolio. So, I mean, we're running our models at a much lower gold price. And as we've said, we expect to be pretty much de-geared in 12 to 18 months. And that's sort of, again, the benefit of having these low-cost surface operations like we do. And also the fact that we've pretty much spent all of our significant growth capital in terms of the Evander Underground and MTR and Australia. So now, certainly now we need to focus on optimizing these assets, and in this gold price environment, the rest will take care of itself.
And the group has been quite adamant on its road to decarbonize, really focusing on renewables. How far are you with that plan?
So we were the first miner in South Africa to actually commission a large-scale plant at Evander, and then we followed that up with a plant at Barberton. So about currently 10% of our energy comes from renewables. The saving, is incredible. So we, in terms of power cost, because of these two plants, we save 7 odd million rands per month, and obviously that's going to increase as we see Eskom ramping up their prices. So we have 40 megawatts that will come online in 2026. That's in terms of a power purchase agreement with Sturdy. And then we're looking at expansions both at MTR and also at Evander. So, our plan really is to look to be 50% renewables, I would say, in the next 2 to 3 years.
All right, well, keep watching and maybe chat to you again in the second half for an update on those plans. Cobus, thanks so much for joining us and taking us through the results. That was Cobus Loots, CEO of Pan African Resources.